Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Have the teeth been pulled from the so-called FAANGS, and what's going on with Bitcoin? Eric Hadik from InsideTrackTrading.com examines the cycles we're seeing for gold, the U.S. dollar, the stock markets, crude, interest rates, disease, and global conflict. WolfStreet.com publisher Wolf Richter takes a look at skyrocketing used vehicle prices in the U.S. Will they come down anytime soon? He also points out electric vehicle prices should come down because e-cars are inexpensive to make. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at ChartsByRoss. Welcome back to the show.
Always a pleasure to be with you, Jim.
What's been happening with the major stock markets compared to the small caps?
Well, we had the big names, the FAANGS just led so much through the spring and into the summer, and now we've gone into this consolidation mode as far as those are concerned. If you take a look at the NASDAQ 100, I mean, it topped out here back in September, just been thrashing around, had a poor week this week. The index down from the high 290s getting down to the low 280s, so a downside bias in there. The S&P, the same type of thing, and the Dow, but starting to see this movement, into different areas. The small caps in particular, if you look at the Russell 2000, the IWM would be the ETF people can take a look at there, had a really nice week and closed up near the better part of its range for the last couple of months. I mean, really, you've got to go back, if anything, we're going back to tease that February high as far as the Russell's concerned, and seeing also some very nice action as far as the utilities are concerned. The XLU having a nice breakout move here, and in the banks, U.S. big banks, not doing terribly well. But if you look at the regionals, the KBE, getting a nice move there out of a long consolidation that we've had since that first recovery bounce off the March low. So there's this rotation going on out there, and clearly, investors should look to take advantage of that. The Bitcoin has probably got a fair amount of legs left in here. Nice breakout this week, and it's you got a few different ways to play that. There's a few ETFs out there, as well as the individual coins that one can participate with.
What's going on with the yield curve?
Well, you take a look here at the 10-year yield versus the 3-month, or the 10s versus the 2-year. That has been moving. We've got the bond market starting to ease off, and I'll get to that in a second here. So the yield curve is moving, and with the longer end rates starting to move up relative to the short rates, because the short rates are going absolutely nowhere. But when you see this flip in the curve, it tends to have a negative impact on the overall market. However, the area that participates well, and there's usually a lag effect here, once the yield curve makes its turn, then a number of months later, you start to see small caps outperforming the big cap names. And that's all part of what is now showing up with that Russell 2000 starting to outperform the big names in terms of the equity market. So if this yield curve continues to walk its way up, then continue to look for the Russell to do reasonably well relative to the S&P and to the Dow. And we're coming into a seasonal period here where you would normally be looking for the classic sell-off or end of weakness as you get towards the end of October through the end of November. So it's a stretch where you'd be looking for some decent buys. And, with the election coming up in a week and a half, there's bound to be, a fair amount of volatility, both going into and out of that, especially considering that the results of the election may be delayed for a while. So, look for opportunities, in particular some of those smaller cap names that might be coming to life, or take a look at the utilities on a pullback as well.
We've always had this argument, gold versus Bitcoin. Are the Bitcoiners getting a little more ammunition?
Yeah, they are. When you take a look, the Bitcoin was, for a while, the two were moving pretty much in lockstep. And then we started to see Bitcoin outperforming the gold market. And that's what we're seeing right now. I question just how long that will go on. Some of this strength that we saw in Bitcoin this week relates to the weakness that we had in the U.S. dollar. Dollar had peaked out just shy of 95 on the index a couple of weeks ago, and that was that 23% retracement rally, and it was up against the weekly moving average resistance. As the dollar has been coming off, alternative items were getting a bid there. Bitcoin clearly getting a good bid from that perspective. And the gold and silver had an initial bounce towards resistance, that 1925 level as far as the gold was concerned, and silver up in the 24 and change level, maybe 25 and a half, I guess, was the top of that silver bounce that we've had. Now, from my perspective, the gold and silver are really nicely positioned here, where we might have maybe another week or so of a little bit of thrashing back and forth, and maybe a test of support. But any close in gold above 1925, 1927, and I think that becomes a catalyst point for a bit of a rally. Both the silver and gold had good resistance this last 10 days at appropriate levels. And if they can take those out, then I think you're looking at the silver market maybe getting up into the 2680. That would be minimum target. And we've got an upper band that's closer to 28. Would expect that if you've got the short-term breakout, we probably got anywhere from 4 to 5 weeks of decent upside action in those precious metals. But it's going to take a catalyst to get that going. And we'll provide that information to our subscribers.
Ross, thank you so much for being on the show.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMY.Resources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from the Chicago area. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, can you tell our listeners a little bit about InsideTrackTrading.com?
At Inside Track, we do technical and cyclical analysis on the financial and commodity markets, providing some various publications on different time frames that are aimed to both educate and inform traders, also preparing them for specific moves in the markets, discussing trading strategies, etc.
Eric, do you think we've seen the top in the gold cycle for a while?
I do think that gold has set a 3 to 6 month peak. I've been talking about that, focused on the August-September time frame all year. That was when I thought we would see the second similar peak that cycles peaked in early in the year, and then we're showing a subsequent peak in August-September, and then what I believe could be a final peak out in the second quarter of next year. But between those two final peaks, you also expect a multi-month valley, for lack of a better term. And so when gold peaked in early August and also fulfilled many daily cycles that were in focus at the time, it corroborated those longer-term cycles, and then I look for technical action and price action to validate those cycles. I'm not just looking at certain cycles and then trading off of that. I need to see price action confirm or negate those expectations, but it definitely confirmed it in early August, and my work has been showing that we should see another sell-off. We've already seen two moderate sell-offs, but another sell-off between October 20th and 26th, and then probably a fourth sell-off in early November. But I do think it's going to be some time before gold and silver make it back up to those highs that they saw in early August.
Do you think we've seen the top in the silver cycle for a while?
Yeah, as I said, I think it's similar, but I do think that silver continues to be the market that will outpace gold, particularly on the advances. And by that I mean that, the intervening corrections, silver might not hold up as well, but during these advances, between the period of March 2020 and April or May of 2021, that I think silver will see proportionately better gains, and as I've described before, a lot of that is related to the economic environment and the likelihood that we'd be seeing some inflationary advances in a lot of the markets, in commodities, and then as a result in a metal like silver, which benefits far more from an inflationary environment, whereas gold is more political uncertainty and even stock market uncertainty sometimes is when you get your biggest gains in gold. While I do think silver has peaked for a few months, I think that it still has another good advance ahead of it. But in the interim, my downside target, since it peaked, the downside target has been getting back to $19 to $21. It would not surprise me at all to see it spike down to that right around the $19 level before a bottom is set.
Where is the U.S. dollar in the various cycles?
The dollar, I think, is in a multi-year trading range, and the extremes of that trading range were set by the highs in early 2017 and the low in early 2018. And for any of your listeners that are familiar with even basic wave or Elliott wave theory, what I've been looking for and what continues to play out is sort of what would be called a flat correction. And whereas normally you think of a correction in the market as angling downward, a flat correction is more just a lateral sideways type movement where you get an initial decline to a certain support level, then an ensuing rally that goes back up to the previous highs. So basically you've got a horizontal trend line there between the original high and the second high. And then it sees another down wave that goes towards and usually bottoms near the previous low. So again, you've got a horizontal trend line between the two lows. And that's kind of what I've been looking for in the dollar and what we've seen play out. The initial decline into early 2018, then the rally back into March of this year where it peaked right near its early 2017 peak. And I think that it is on track to head lower into at least March of next year and back down to similar lows as to where it bottomed in early 2018. I believe that's around the 88 level in the dollar index. But that's something, too, that if we see another wave down late this year, early next year, that's something that could also play into the gold and silver analysis that we were just talking about, that would be after gold and silver have bottomed out in this correction and when they're ready to resume their advances and unfold or evolve in at least one more up wave.
We're hearing the Dow could head down towards 20,000 points or perhaps move higher towards 40,000. What do you see ahead for the Dow in the various cycles?
The Dow has, in my outlook, has not really changed much since March of this year. I thought we would see a major bottom in late March of this year, and then on balance that it would move higher into April or May of next year. I still believe that to be the case. Everything that all of my technical and cyclical work continues to corroborate that. I haven't really seen anything that would negate that or send up any big warning signs that maybe I'm wrong. So that continues to be the outlook. I do think that we are going to continue to see some volatile swing trading in this September through November time period. But then I think we're going to see another surge once we get through all of the uncertainty surrounding U.S. election and international geopolitical ramifications of that election as traders start to digest what the results of that election will mean for, U.S.-China relations and economies and many of the other repercussions of the election. So I am still looking for more upside in the Dow on balance, but that doesn't mean that it's just a straight surge from here.
From time to time, can cycles constrict or extend in time?
Oh, absolutely. And, there's an old adage or principle in cycle theory that in strong uptrend cycles shift to the right, which basically means when you're looking at a chart and you've got a particular cycle high that's anticipated, price action will often push that farther out in time. And that is why I continually stress to all of my readers and anyone listening to me in anything like this interview that price action needs to be the ultimate filter. So for me, the cycle analysis, and even when I refer to wave and Elliott wave theory, they are a little bit more subjective, a little bit more of an art form. So they provide the backdrop for what I'm going to ultimately do in the markets. but I then need to see a sequence of technical and price action validate those cycles and those wave expectations and trigger specific signals in one direction or the other, and at the same time provide the risk parameters for those trades, basically saying where that analysis might be wrong if the market turns against me. So I do certainly allow for some variance or some leeway within cycles, and that's why price action and the related technical indicators are so important to govern action and decisions in the markets.
Do you see any cycles that are currently bottoming or topping?
That is a good question, and I guess the big clarifier there is on what term, because there are certain commodities that I thought we would see multi-month peaks in this August-September time frame. We've already talked about metals and some of the other commodities pushing into the current October time frame. So I think that they are in line for a multi-month top, but on a major basis, something that would trigger, at least a 1 to 2 year peak or bottom. Nothing really stands out to me at this time. I do think as we get into second quarter of next year, that's the time when several cycles have the potential to be setting major tops in things like metals and equities, and major bottoms in things potentially like the dollar.
We'll have more with Eric Hadik when This Week in Money returns.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, the U.S. Fed says interest rates aren't going to be going up for years from now, but can they actually control real interest rates, which I hear are set by international markets?
Well, I've kind of addressed that overall mindset or expectation in some of my longer-term analysis on bonds and notes. Those markets which trade inversely to the actual interest rates, I was expecting a major multi-year top in the middle part of 2020. There's been a very consistent 4-year cycle in those markets, and most recently it's at similar peaks in middle of 2012 and middle of 2016. And coming into 2020, everything was reinforcing that outlook, and as of right now, bonds and notes did peak in late July, early August, and have started to give some downward reversal signals. But the point being there is that I believe the expectations, which are what drive the markets, those interest rate expectations hit their nadir, hit their low point in middle of 2020. And even though the main Fed governed rates might not change for a year or two, I believe the perception of and anticipation of interest rates is going to slowly shift, and that you will see some of those related rates start to bump up in the coming 6 to 12 month period, and I think that too could be a function of if my other analysis is accurate, and we see commodities and metals and stocks move higher into the second quarter of 2021, and coincidentally see the dollar move lower into at least the latter part of first quarter 2021. All of those things are market factors that would typically push higher on interest rates or interest rate expectations. So I definitely think you're going to see some movement in that direction. And, you know, the Fed could be still holding to their commitment and not raising their key rates, but at the same time the market is doing a little bit of that for them.
What do you see in the crude cycle?
I'm anticipating energy markets to continue to move higher, although it be a very kind of volatile back and forth type of action. Into the end of this year, there are some cycles in heating oil and in crude that I'm looking at in late December. Natural gas has been in a bullish cycle since March of this year, and since that time I've been saying that I thought the initial impulse wave in natural gas would carry it higher into November, December of this year, although I believe that's in a longer-term bull market, so this is just the first phase of that. But all kind of compiled there, it looks like the energy markets will be on an upward slant into the end of this year. And crude, I continue to talk about the primary upside objective for this overall advance from April, being that crude should get back to around the $50 level. And depending on when and how that is tested, that would really help mold expectations beyond there, whether there's still time and room for more upside beyond that, or whether that's the extent of a move up in crude.
Is there an agricultural commodity cycle, and if there is, where are we?
Well, each ag market has kind of its own cycles, and you even see, you know, within agricultural, you can break it down to your grains, your livestock, your softs. They all kind of come under that umbrella, and often, sometimes they're running in concert with each other. Sometimes it's opposite. You know, if you get grain prices really heading higher, sometimes that can have a negative impact on livestock, and vice versa. But the grain markets are one of the ones that, I've been watching the closest this year, and I do think that they have been in a bottoming phase since late 2018, and all of my work was showing that I thought we would see an initial surge in the third quarter of this year, which we've just completed. And there's some carryover in the rallies in soybeans, corn, wheat. But I think that is an initial stage of a broader advance that you're going to see. And I am watching the wheat market closely later this year, that if we peak right now around 640, 650 in wheat and can pull back, I think wheat has a lot more long-term upside potential to it within the context of those cycles.
Do you see where we are in the disease cycle, and was this pandemic predictable?
From a very broad and general perspective, there are some disease cycles that I wrote about back in the late 2000s and then the mid 2010s, back in 2014, 2015. And the conclusion drawn in those reports was that 2018 through 2020 would be the next spike in virus and influenza-related cycles. And so from that perspective, there some general expectations were constructed, but anything more specific than that, I don't claim to purport that cycles can anticipate much more than that.
Eric, you've told us in the past about wars even follow cycles. What kind of a cycle pattern are we in right now?
I continue to focus on 2021 as being the next phase of longer, both 40-year and 80-year cycle of war. That is when I think you could see things start to escalate. I could certainly look at current events and speculate on where that might occur, but inevitably you get curveballs with things like that. I certainly am keeping a close eye on the South China Sea and how tensions between the U.S. and China and some of their neighbors evolve over the coming year, particularly after the U.S. election. But there are a lot of potential hot spots out there, and like I said, it's often from an unexpected corner of the world where things like that find their fulfillment. So from a cycle perspective, for I'd say 7-8 years now, I continue to write about 2021 being the time when I thought we would see war cycles start to take center stage again. And that's certainly a broader, longer-term cycle, so that would just usher in a multi-year period. But I think when you're able to look back with 2020 hindsight, be able to pinpoint 2021 as the real trigger in whatever conflict follows that.
Eric, how far back have you followed these violent cycles?
Those, and in particular an 80-year cycle of war, I've documented back about 600-700 years, and starting throughout Europe, but then impacting America since our founding, and most recently you see the culmination of the Revolutionary War in 1781, and then so that was really when America got beyond that War of Independence and then started to move forward. And exactly 80 years later, in 1861, was the start of the Civil War. And exactly 80 years later, in 1941, was America's entry into World War II. So even though, some of those conflicts, particularly World War II, had already been going, that cycle has more emphasis on America's involvement in it. But in each case, you can also look back and see the seeds being planted in the years leading up to that. So that cycle is something that, like I said, I've looked back for many centuries, and it's been pretty consistent, becoming even more precise in these last couple hundred years. So that's why I continue to focus on 2021.
Is there a presidential election year market cycle?
There are different cycles like that, and they have different impact on the year leading into the election, whether it's a incumbent or not. I do not follow or adhere to them as closely because they are very general in nature. So that's something that I really don't have a strong conviction or opinion on.
Eric, how can people find out more about InsideTrackTrading.com?
The easiest way is to go to our website at InsideTrackTrading.com. That's with the extra I in the middle of inside, so it's INSIIDE, TrackTrading.com. You can also see a lot of our archived 40-year cycle related articles on 40yearcycle.com. That's the numbers 40 and then yearcycle.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from the Chicago area. Now we zip over to San Francisco, where we'll be talking to Wolf Richter next on This Week in Money.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, before we get going, can you tell people a little bit about wolfstreet.com?
Yes, wolfstreet.com is a business, finance, economic site. We stay out of politics, particularly partisan politics. So it's all business, finance, and economics, and everything is free.
Can't beat that price.
You do have to put up with ads, but there's no subscription.
Wolf, there have been reports that used vehicle prices are skyrocketing. What's going on?
Yeah, that's been quite an amazing sight. We, during the early phases of the pandemic, during the lockdowns in March and April, the used car market in the United States actually froze up. And there's the wholesale market, which is huge. In the United States alone, there's something like 25 million vehicles in the wholesale market every year. And so it's the backbone of the used vehicle retail market. It's the sort of the backbone of the new vehicle market too. And it froze up. The auctions just didn't happen anymore, and prices dropped sharply at that point. And then suddenly there was a surge in buying from auto dealers as they were replenishing their inventories, and prices began skyrocketing, and on the wholesale side. So retail prices lagged behind a little bit, but wholesale prices just surged past the price levels where they'd been, and went on further, and at the peak ran about 15% above where they'd been. 15%, above where they'd been just before the pandemic. So this is not a 2 or 3% increase. We're talking about 15%. And they have since, so this is early August, and so now they're starting to come down on the wholesale side, and they have dropped about 5% since that peak, but they're still above, quite a bit above where they've been before the pandemic. Now this is washing through to the retail side. So retail prices started, so they tapered down and that's into June, and then suddenly they skyrocketed. And we don't really have retail prices from the industry. These wholesale prices come from the industry, but the retail prices we get, the retail price increases come from the inflation data, from the CPI data, and so they're reported by the government, and they're a little different, but those so the used vehicle CPI, so the consumer price index for used vehicles, it jumped by 15% in 3 months. So July, August, and September, it jumped by 15%. And so when you think about that, that's a gigantic amount, and it means that incentives went away, everything went away. Dealers charged more than they did before. All kinds of things happened on the truck side. So the used truck side, there were price increases of 25% year over year on 1-year-old trucks. And so when used vehicle retail prices jumped 15%, And wholesale prices jumped about that much 2 months earlier. Yeah, you're talking about a market that is overdue for a reset. And used truck prices jumping 25% year over year. That cannot continue. This is not. We're not in a world where this just can keep going like that. And so I expect used retail prices to come down as the wholesale prices have already started to. When you look at the chart of these used vehicle retail prices, it's just a candlestick going straight up, and that has never happened before in the history of this data. And so this is unlikely to stick around. There's lots of inventory out there. There's no inventory shortage. Now we've got the Hertz units coming on the used vehicle market. The Hertz was bankrupt, filed for bankruptcy, and those vehicles, so it wanted to defleet, reduce its fleet, and those units were locked up in bankruptcy court for a while. So starting at the end of July, Hertz and its creditors came to an agreement on those units, and so they started to show up in August on the wholesale market, and that's why one of the reasons why wholesale prices started dropping. Now we're talking about several 100,000 vehicles there, used vehicles there that Hertz will have to sell over the next couple of months, and so we see that price pressure happening there. I expect used vehicle retail prices to follow suit. Those units are starting to show up on dealer lots. Dealers have bought those, and they're starting to show up. So there's plenty of inventory out there. There's no reason now for prices to stay at these levels. This is used vehicle volume, retail volume, actually still below last year. So used vehicle retail volume never caught up to where it was a year ago. So these are price increases that happen despite lower than normal sales volume on the retail side. And obviously we just looking at the charts, you cannot go on like this. And the wholesale charts have borne that out. So they have solidly rounded the corner starting in August, late August, early September. And I expect retail side to do the same thing, and the used vehicle retail prices to come back down. When prices are this high, it's just not a good time to buy a used car. This is not the time to go. You can go shopping, but don't buy until this settles down, because this is a ridiculous price increase.
What's happening in the new vehicle market?
Yeah, so new vehicle sales are overall still down from a year ago in September. On the retail side, they've been pretty good. On the fleet side, they've been terrible. So fleet, you're talking about rental car fleets mainly, and corporate fleets as well. They have cut way back. So fleet sales are way down from a year ago, and you're talking double digits. They have been since March, and there's a huge amount of sales that didn't take place over those months. Now, retail sales are now catching up with where they were a year ago. There's a lot of sales were lost during those 7 months in between, and we're not catching up those lost vehicles, those lost sales. So this year will be a significant down year, even if the rest of the year is very strong. And it's going to be better than it was in the past few months. But going forward, there may be a little bit of pent-up demand coming out, but the market is not on fire. It's doing pretty well, but it's not on fire now, and so I think we'll have overall a pretty lousy year, even though the latter part of the year will be pretty good on the retail side. An interesting thing is happening. Every automaker is now coming out and promoting EVs, electrical vehicles. And that is a generational shift in the industry. We just heard the Hummer promos from General Motors. General Motors already has an EV out Bolt, and the others are coming. Ford's coming out this fall, and every automaker's got it now. Volkswagen. I mean, there's tons of vehicles out there now, and what this will do is it will change the manufacturing infrastructure. And so GM is investing all this money into plants here in the United States to build these EVs, and they're talking billions of dollars. And the thing with EVs is they're incredibly cheap to build. The only hard part, expensive part, is the battery. And automakers don't really build the battery cells. You know, that's not a technology they own. So they and they can develop their own batteries using somebody else's battery cells, or they can just buy the battery off the shelf from a supplier. And every other part of an EV is just a commodity item. So the electric motors, all these things they're available from suppliers, and any company can design an EV and start selling it, and you start seeing that. You know, now we've got all these startups developing EVs. There's a huge amount of money being invested in them. I don't know if they ever will come up with anything, but I mean, this is just an enormous amount of money that's flowing into the development of EVs, not just from legacy automakers, but also from these startups. And because it is so easy to build them, and it's so cheap, they're so cheap to build. Outside of the battery, you know, they're incredibly cheap to build. Teslas have a trunk under the hood because there's not much you don't need much space, yeah. And maintenance changes a lot. So there are essentially no moving parts outside of a couple of moving parts in an electric motor. But the rest of the engine and drivetrain, you know, this just disappears on an EV. So the maintenance items are minuscule. So it will when these numbers take off, you know, it will shift entire service sector of the auto industry, and that's a big part, you know. And so it will have a huge generational impact when this is coming. And it requires different manufacturing plants. It requires a lot of investment. Since those vehicles are easier and cheaper to build, there will be a lot of job losses when production shifts over. And Volkswagen has already announced tens of thousands of job losses for future years as it's switching over. And that's the kind of thing we're looking at. Yeah, it's just there's just a generational change in how cars are manufactured, and it could be that there are successful car companies emerging that barely have any manufacturing plants. You know, that they're just designing the cars, and the cars are then manufactured and assembled by suppliers. I mean, I can see that coming because it's just taking the core of an automobile, the internal combustion engine and the transmission and all the complexities and the mission controls and the heating and cooling and you know, the oil systems and all this stuff is taken out. And this is proprietary technology for most automakers. And this proprietary technology has been replaced by an electric motor that's essentially off the shelf. And so this is what I think is going to be an enormous threat to the legacy automakers, and that's why they're spending billions of dollars getting on the ballpark, because now they can be attacked by younger and inexperienced companies, whereas before they really couldn't. And you know, I'm not a fan of Tesla's stock price. I think it's ridiculously overpriced. But Elon Musk has single-handedly created this industry, and now the other automakers are forced, you know, to follow. And you know, I think there will be a lot of bloodletting in the industry over this. This is going to be a turmoil and shift that's going to be rough to do, and at the same time, it'll be fairly exciting because there's finally something new coming to the industry that we haven't seen, and so I'm somewhat with trepidation looking forward to this change in the industry, you know, because as we have seen, it will bring manufacturing back or assembly back from other countries, because it's so much cheaper to put these cars together here. You really don't need to, it doesn't require as much labor. So the labor component is going to decline a whole lot. And if labor is more expensive, it's less of a problem. And the expensive part being the battery. The battery are not really automaker technology. So this is going to be a phenomenal thing to watch, I think, as it will play out over the next 5 years or so.
Wolf, could you see your local car dealership offer your own custom designed 3D printed car right on site, where they have 4 or 5 basic chassis that they can offer you on the computer? Look, you can build pretty well your own custom car, put your cup holders where you want and so on, as long as it meets Department of Transport safety minimums or parameters. Print your own car right there.
Yeah, that's funny. Yeah, I don't envision that. 3D printing is good for some things, and it's been around for a long time. I mean, circuit boards have been 3D printed for a long time. But in terms of 3D printing elaborate consumer products like a car with all these complex materials and surfaces, leather seats and all this stuff, no, I don't expect that to happen. But a certain part of what you said is I think is very likely, in that there won't be 3D printed, but you can probably custom order you always custom order a vehicle, but since they're now so simple to build, you can probably custom order one and have it delivered much more quickly than before. And that was always an option. You could pick your things, and they will go on the production line. The order, and then it will go through, and it will take months. You sit there and you wait for your car, and so now maybe this might speed up the process. But 3D printing of a car, even of just the body and the interior, I don't see that coming in my lifetime.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, is work from home just a blip during the pandemic, or is there more to it?
Well, a lot of people obviously think that we'll get back to normal after the pandemic is over, and offices will fill back up. But that's not what companies are saying. And so we now hear announcements coming out, and some of the biggest ones, the smaller companies don't announce anything; they're just doing it. But some of the biggest ones, like Microsoft and Facebook and Twitter, and all those, have already pronounced permanent work from home policies, and each one's getting a little bit more radical. Now, the last one to announce one is Synchrony Financial, which is a big consumer financial services company in the United States, credit cards, that kind of thing. And they have 16,500 employees around the country, and close to 24 offices in different places. And so they came out with a permanent work from home program that is a lot more radical than the others, because they grouped their employees into 3 categories. And one category is the virtual office employee. And this category of employee does not even have access to an office. So they work from home all the time, and they cannot even go into an office. There is no office for them to go into. And so they don't need to have management meetings in an office or anything. There's no office. And Synchrony has a lot of employees that do collection work and that do other things like that, and credit checks and different things. So that can all be done at home. And so there's a group like that. Cannot go to an office, will not have an office available. And then there's another group of employees that are on what Synchrony calls hoteling office method, where they have to book a chair seat at a desk in advance. And they can come in, but they have to book that. And they work from home permanently most of the time, but if they need to meet with somebody, they can book that. And they can also visit some meeting places. And then there's another group of employees that have assigned seats in offices. And so they can go to the office up to 3 times a week and know where their seat is during those days, and and they do other stuff at home. And then there's management, and even management with assigned seats. So there are managers apparently who don't have assigned seats, but managers or executives with assigned seats, even they need to work at home one or 2 days a week to lead by example. So this is the first time I have heard where a good part of the employees don't even have access to an office anymore. And as a consequence, Synchrony said it will reduce its office footprint by quite a bit. It already has closed some offices. It will close some more offices and reduce some offices. And so it hopes to save $250 million next year through this footprint reduction. So it's all about cost savings for the company. That's all they're thinking about. How can we reduce costs? And it's starting to make a lot of sense. Now, some jobs are obviously not being done at home, and even office jobs, having to do with certain things, you need to go to the office. But more and more jobs are just perfect for homework, and so they're being sent home. And this is an interesting thing because it shifts the expense of an office from the company to the household. And so when 2 people work in an office and a couple, and they go home and then they spend the evening and the night at home and then the mornings they depart. And, so they need less space that way than when they spend 24/7 at home, both working at home for the companies. And so they will probably need 2 separate offices and 2 separate tech setups for that. And many people in condos don't have enough space to do that. Even in a small house, that would be tough to do. So if these are, you can do it short term for a few months, but in terms of working out of the bedroom, but long term, you need separate work spaces and you need to be fairly comfortable. So there is already a trend in real estate to these larger homes where people can have home offices, sometimes 2 home offices in a home. And this is starting to be part of society, and it's starting to be part of business. It's not a blip anymore. This is starting to be built in, and companies are figuring out that they can save a lot of money doing that. And this is really bad for office landlords and downtowns and those kinds of things. I mean, people have to, the landlords will have to do a lot of creative thinking to deal with that. On the other hand, I think it will revive neighborhoods in terms of creating cafes and restaurants and other things. Because when you work at home, the first thing you got to do is you separate your social life from your work life. At work, when you work all day, the company hands you your friends and it hands you your social life, and that's not really a good idea. But that's how it happens. People date each other and they go out after work. They go out during lunch. They play sports together. They do stuff together. So their social life is with their colleagues at work. And that's really an awful idea when you think about it. You want to have a separate social life from your work life. And so when you work at home, you have your work life and you create your own social life separate from your work life. So you come up with your own friends, you join clubs, you go to different things, and you're active socially. And one of the things you're doing, instead of going out after work to some bar or restaurant near your office or on the way home from the office, you can go to a cafe or a restaurant or bar in the neighborhood. And so I think, and with already seeing a little bit of that, I think that neighborhood institutions that sort of died with the commuting culture, they will revive, because every neighborhood needs to have places where, when people work there, they need to have places where people can gather, where they can go out to lunch or go out to dinner and go sit in a cafe for a while and have a social life. And so I think the expense will shift to the household, but on the bad side, but the good side is that the responsibility of creating your own social life also shifts to the household, and that has all sorts of positive effects on the neighborhood, on society, on the household itself, I think. And so overall, I see that as a very good move. But there's going to be a lot of turmoil in commercial real estate because of that, and we're seeing that turmoil already. I mean, office properties. Suddenly we've got the tsunami of sublease properties on the office market where companies lease too much space they don't need it anymore, and now they're putting it on sublease out on the market. This has just flooded the market in the third quarter, and we're going to see a lot more of that. So I think there will be a lot of turmoil in the office sector of commercial real estate.
Could we be in for a surprise rise in interest rates in the near future?
Well, let me say this. If I announce it today, that there's going to be an interest rate increase, it's not going to be a surprise rise anymore. So the Fed has allowed long-term rates to tick up. The Fed can effectively control long-term rates by buying assets, by buying Treasury securities and mortgage-backed securities. And interestingly, there hasn't been a lot of appetite to do more than that. And in Canada already, the Bank of Canada has stopped buying mortgage-backed securities. I expect the Fed to start moving into similar direction after the election. Before the election, they have a period where they just don't change policy. Remember this election. So after that, I think they will start making movements in that direction. I don't. They need to keep the bond market alive. If they repress interest rates too far as inflation rates are rising, you're going to have a real problem in the bond market, because the Fed will have to dominate it completely. It will have to be in there with trillions of dollars all the time, and there won't be a bond market. If long-term interest rates are allowed to rise sort of in line with inflation, then there can be a bond market, and the Fed may be willing to do that. Now, I won't say will, but it backed away from controlling long-term interest rates outright through policy. I mean, it had an opportunity to do that, and it decided it wasn't going to do that. So it just buys assets now, but without major announcement what its goals are for long-term interest rates. So I think there's a possibility that the Fed will allow long-term interest rates to rise further than they have already risen. So the U.S. Treasury rate is already at 0.8%, which is still very low, but it's higher than it's been in recent months. So I think it's a possibility. I don't know how high interest rates will go. The Fed will not allow them to go very high, but the 10-year yield could go over 1%, and that would be a big change. If the Fed backs away from mortgage-backed securities like the Bank of Canada did, it would probably increase the spread a little bit between 10-year Treasury yields and mortgage-backed and mortgage rates. So you would get a slight increase in mortgage rates, a slightly steeper increase in mortgage rates, and this might be welcome given the land grab we've got going on in real estate right now. I think every central bank is worried about this land grab, and they realize maybe that they went overboard, and that they need to allow long-term rates to tick up a little bit.
With interest rates dropping recently, have mortgage refinancings led to more consumer spending?
Yeah, there has been a surge of refinancings, and of course, only the refinancing that is a cash-out refi would support additional consumer spending, and there has been quite a bit of that too. Now, lenders have gotten a little bit more careful with cash-out refis, but there's quite a bit of it. So this has added cash to consumers' pockets, and they have likely spent some of this. I mean, we have had record retail sales in the United States and in Canada too, and consumer spending is still down overall. Yeah, so consumer spending on services, especially, and this includes travel services and it includes other services. Service included, this is like 2/3 of what consumers spend on services. But in terms of retail, durable goods especially, consumers have splurged. And this is typically the case when you have some extra cash in your pocket, that where you make one-time purchases and rather than services, which are often repeat things. So they've bought all kinds of appliances and other goods and they've bought very expensive cars. The people with money have bought cars, and the people without money, they didn't buy cars. So we've got this shift towards the high end in car sales. And so I can see that some of this money went into purchases of consumer goods, and I don't know how much that would be. I mean, there's a lot of that going on from other directions too. We've had this extra unemployment compensation. We've had the stimulus money. So there's hundreds of billions of dollars of government money was handed to consumers, and that probably is a far larger number than the cash taking out through refis. But definitely, anytime you have large number of mortgages being refied on a cash-out basis, that money is going to get spent. It's not going to just sit there. So eventually this money becomes purchases of some sort.
Are we likely to see universal basic income take hold in some countries?
Well, there's some experiments going on, and none of them successful so far. The idea of universal income is to replace all other forms of government support. So unemployment, disability, possibly retirement income from the government, any sick leave, that kind of thing. And so you would really not get anything anymore other than money from your job. And the problem, and so in that sense, it makes sense. It simplifies everything. And you have some kind of basic income when you lose your job, or when you become disabled, or when you retire, or when you get sick long term, or whatever. The problem with that is that the universal income goes to a lot of people who don't need it, and who have a job, who don't need this additional money, and then it gets very expensive. And, that's always the issue. Well, where does this money come from? And, when a city does that on a project, they sign up a few hundred people and they set aside, some amount of money that maybe somebody donated or whatever. They do it for a few years and it's a limited project and limited funds and fine. But when, a whole country does that, who is going to give that country this money to do that? And that's the unresolved question. You can print the money, so that's not great, or you borrow it somewhere, but borrow means from the taxpayers, from the same people that are getting this money. And so it's starting to not make sense once you start to go through the cycle of where this money comes from. You can print it, and you can monetize that thing, and then obviously you will destroy your currency through inflation, and there is really no way around it once you start doing that. You created universal income. The people that get paid in this currency is being increasingly destroyed and it becomes worthless. And so it's I just don't see any realistic way for the whole country to do that. Yeah, it's just until we figure out who pays for it, it can't really be done. And people say, well, we can print it, and that's the same people that say we can print. The government shouldn't even borrow. They can just print it, and that works fine if you print just a little bit, But if it's for the whole country all the time, forever, you're talking about the destruction of the currency, that's kind of the end of an economy. When you do that, you're looking at what an economy Venezuela has, or Zimbabwe, or some of those other countries, or even Argentina. A large amount of inflation makes an economy very dysfunctional, and so I don't. At this point, I have not seen anything that allows me to think that universal income can be pulled off without destroying the currency. So I think countries will be very careful to embark on this on an overall country scale. I mean, they can do experiments, but on a small scale. But for a whole country to do this overall, unless you may have a tiny country and it has a natural resource that the whole entire country can live off without ever having to work a single hour's worth of work. And maybe this particular country could afford to have universal income as long as there's natural resources around, and that may be long enough, for a few years. But that's just not a normal case. So for just a normal country, I just don't see that as a possibility.
Why are people moving out of California?
Well, people have always moved out of California, and because it's expensive, and California is a gateway state, like many other states, so when you look at migration between California and other U.S. states, there has been a deficit for many years. So where more people migrate out of California to the rest of the United States than migrate into California. And that's kind of the standard procedure. And at the same time, California gets a flow of immigrants from in California, it's largely Asia, so India, China, some other places, but also from South America. And so the immigrants that come in generally tend to be larger in number than the people leaving California and going to other states. And that's happening in all the gateway states. So that's happening in Canada, that's happening elsewhere. You've got immigrants moving in, and you've got other people moving out. And the other people that move out may be immigrants that arrived 5 years early, or there may be people that have come from other states and they're going somewhere else. I mean, you have a lot of movement that way. So, but overall, the principle has been that more immigrants are leaving than the net out-migration to other states. And I mean, that more immigrants are coming in than the net out-migration to other states. Now, this year is different because this year the influx of immigrants has almost stopped. And it's just down to trickle. And the outflow has continued. And in terms of the cities, so San Francisco, for example, we now have an increasing pile of data that shows that people are leaving San Francisco. We have surging vacancy rates in apartments and in condos, and rents have already plunged by 25%. We have a historic glut of condos on the market in San Francisco, never seen before. I mean, so these are people that, San Jose Valley have all this. We used to have a housing shortage. Now we've got all this housing on the market and not enough people to fill it, with not enough money to fill it. So we know that some people have left San Francisco. We don't know yet where they went. So some of them went further out into the Bay Area. So they moved. They're working from home, and they moved 50 miles out, and they're still in California, or maybe they moved to the Central Valley, or moved to Redding, or some distant place where they're hours away, but still in California. Other people left the state. We don't know the numbers about that yet. I mean, there are annual numbers coming out, but they're way behind, so we don't even have 2018 numbers yet. So, on this data. So we don't know if these people that leave San Francisco go to Texas or if they go into the Central Valley. And we know that housing has, there's been a huge amount of demand in housing outside of, in the outlying areas of the Bay Area. So from that we can tell that people in the core of the Bay areas, especially San Francisco, have, moved to the outlying regions. So we kind of gather that from the housing market. We don't have population data on that yet. We also have seen the same thing in New York and New York City and other places. So this is kind of established. We don't know if more people are leaving California than before. I have a suspicion that that's the case, that more people are leaving California, and these may be mostly people in big cities like San Francisco. I don't know that people in the Central Valley would leave California, but, we don't have the numbers on that. There's all kinds of anecdotal reporting of that. So that might have increased a little bit. A number of companies have moved the headquarters out of California, including Charles Schwab, has moved to Texas, so this is a trend. You have a very expensive state, a very expensive state. You have a very expensive city within the expensive state. And so if people can find a cheaper place to live, that's great. Now, what's changed is that if they have a permanent work-from-home job, they can essentially live anywhere. It depends if they have to come in to work once a week or twice a week. They want to live within 50 or 100 miles. If they have to come in once or twice a month, they can live pretty far away. And so this creates all kinds of flexibility in where people want to live. They don't have to come in at all anymore. They could move to Oklahoma. And it saves a lot of money on housing. And so, I think this is putting pressures on all kinds of things. And we're at the beginning of it. We don't have established data on any of this. But I think that there's a big move like that. And now with the immigration aspect of it cut off, I can almost, see in the housing market, in the San Francisco housing market, that there's a vacuum forming here. And that's the housing market is really the only data points that we at this point have to observe where people are going. And in other smaller cities around the country, people are showing up from California. There's lots of anecdotal reporting about that. So it seems like that's what we're seeing. And this may be, when we get the numbers, 2020 may be the year that California lost population. And I sort of suspect that that's the number that we'll see.
Wolf, how can people follow you?
Everything I do is on wolfstreet.com. So come by. We have a very civilized commenting section with lots of good stuff going on there. I post 1 to 3 articles a day, so that should always be something new. wolfstreet.com.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Wolf Richter. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for our company showcase update from American Manganese President and CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always great to be on the show, Jim.
Larry, your office very busy this past week. You have some new news releases for us. What was in them?
It's been exciting, very exciting, Jim. And, it's very heartwarming to be back looking and doing some work on the Manganese project. And we'd spent about, we have 2 press releases out on it. I'd advise everybody to look at those because it, definitely underlines the support we're getting from the political side in the U.S. And it's to do with the stockpile at Wendon. Now, the stockpile at Wendon is was trucked in over the years. It was up to 2 million tons at one time. Now it's less than 400,000 tons, but it's a stockpile that's sitting there that the grades are 10 times what we've been working with at the Artillery Peak. And the reason those grades are is they enriched the amount of material that went out, and through crude methods, but it worked at the time. And they've enriched that to about 21%, which is 10 times the grades that we've been working with at Artillery Peak. Now, the exciting part of this is that we're doing this for the Department of Defense, the DOD, and they need electrolytic manganese metal, which is controlled by China, and they control the price. They kept it down, and they pretty much had taken over 98% of that industry. So the U.S. has got to come up with their own solutions within their country, and we're willing to provide that. Now, the releases, I would advise everybody to take a close look at them. It's probably the first time that a Canadian company has been supported in an application to do work on mineral deposits or the stockpiles in the U.S. Now, what you have to remember about that is the stockpile at Wendon has a town within about 5 miles of the property, so the infrastructure is there. Our process uses very, very little water, which we had to develop because there's not a lot of water available in Arizona to go into tailings ponds. So we've developed a dry process for that, which is environmentally friendly, and we go from there. Now, people have been asking me to talk about how much the grant was. Well, I'm not at liberty to say that. That's being worked on. It's going slow right now because of the elections coming up in less than 2 weeks in the U.S. So, but that'll happen. It's enough to cover off a 47-week R&D program, and certainly, so that's significant. But we couldn't be more excited about getting back involved in manganese. You can't make steel without manganese, and if you can't make steel, the world stops. That's a saying that I've said several times, and which means basically, let me give you the elementary explanation. If you don't use manganese or you try to substitute it out, you end up with a brittle product. Like if you made a sheet of steel, half-inch thick or an inch thick, took it off the concrete floor and dropped it, it would shatter. You have to have manganese to give ductability and strength to the steel. So we are one of the solutions, if not the only solution, for actually producing manganese, metals, and dioxides, and carbonate for that matter, within the U.S. So we're really excited about this. I would advise everybody that hasn't seen it to look at those press releases that will be attached, because it'll show you just how strong the political support is in the U.S. for us. And just as an addendum to this, Jim, the RecycLiCo project is ongoing. There will be news forthcoming on that. Also the Spinout, there will be news forthcoming on that. So we're very busy here. So don't think that we're abandoning the RecycLiCo program. This is an opportunity that doesn't cost us money, and it's an opportunity that should enrich the shareholders.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company that developed a process to treat low grades of manganese in the U.S. back 10 years ago, and we actually spent a lot of money on that, probably close to $20 million, and that money included a study by one of the biggest engineering firms in the U.S. who validated that study. It was called a pre-feasibility study. So now looks like we may be able to recapture all that lost time and get back into manganese along with our recycling program.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can do all your due diligence required by going to our site. There's a lot of information. We've been transparent about everything that we've done, and do your own evaluations. If you're interested in, maybe investing in the stock or following it, I think that's the first place to go. I definitely not advise you to go to the bull boards because that's a different take on what we're doing. And company's site is AmericanManganeseInc.com. You can phone us here at 778-574-4444, or you can basically email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on October 23rd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.